Today is Monday, April 16th, and this is the ADM Investor Services Monday Market Kickoff. Please note that the views and opinions expressed here today are solely those of our guests and should not be construed as the views or opinions of ADM Investor Services or Archer Daniels Midland Company. Today's guests are Steve Freed, Vice President of Grain Research at ADMIS, and Alan Bush, ADMIS's Senior Financial Economist. Alan, let's start with the financials this morning. The probability of a Fed funds rate hike from the Federal Open Market Committee at the June 13th meeting is 95%. Why isn't the U.S. dollar stronger in the light of a very likely rate increase from the Fed in June?
Well, basically, it's other central banks that are becoming more aggressive in raising rates or are threatening to raise rates, such as the European Central Bank is likely to withdraw some of its accommodation. So it's basically not just what one central bank does, it's what they do in comparison to other central banks around the world. So with the Fed likely to raise rates, other central banks are aggressive as well, so the comparative advantage is just not there to support the dollar.
Last week, initial weekly jobless claims fell to 233,000. They've now been below 300,000 for 162 consecutive weeks, which is the longest streak for weekly records going back to 1967.
Right.
How does this report affect Fed policy?
By itself, it would suggest that the Fed might be more aggressive in raising interest rates, but that is basically just one component. There are many other factors to consider, such as the ongoing trade situation, which in itself is a reason for the Fed to be less aggressive. So even though the economy appears to be in good shape from the point of view of jobless claims, other factors have to come into play, and that suggests that the Fed may not be aggressive in raising rates.
Finally, Alan, in the past few weeks, gold futures have been able to remain firm on days when other flight to quality vehicles have come under pressure. What is your outlook for gold futures now?
Well, today is a perfect example of that. Apparently there is a better feeling to the situation in the Mideast today. Many flight to quality vehicles are under pressure, such as the bond market, and yet gold is actually higher today. Gold should have been lower with the other flight to quality vehicles. That has not been the case. That in itself should be viewed as a sign of strength for the gold market. In fact, gold is my favorite long. I would think any $10 break should be used as a buying opportunity. Also, I believe that the gold market is likely to continue to advance in a very long-term basis as well.
Steve, turning to the grain markets, the weather crazy here in the Midwest. I suppose this is the main story right now. Will this change soon, and is it having an impact on prices, crops?
Today's 8 to 14 day map shows that temperatures will stay below normal, but will actually go into a drier pattern. So I think that it really hasn't affected prices as much as you would think, because the farmers can plant the corn crop real quickly with their big machinery, and they'll have the desire to do that. So the other thing is that we have a minimum solar activity this year, which could mean that all summer long temperatures could be cooler than normal. So that might weigh on prices without heat.
How are the technical indicators looking right now, and how important are technicals when weather is the main concern for the market?
Well, we always say the technicians are right first, and the fundamentals kind of catch up to the technicals. But since the market is built up with a lot of these high-frequency trading machines and things like that, they will move faster than the fundamentals. But I think that, first of all, the soybean market tested the season highs on the lower Argentina crop and the record demand for meal that could have to shift around the world. We've reached a top in the market now, and we're starting to fall back a little bit, mostly because of the uncertainty with the trade wars between the United States and China, and if we lose any export demand, that could offset any bigger crush demand. The corn market kind of rallied halfway back from last year's price levels, and now we're falling back because we just have too much corn in the United States, and if we get this crop planted and the weather does change, corn prices are too high. And wheat prices last week broke pretty hard because it looks like the dry areas of the U.S. is going to get a rain. And we also saw a steep drop in the Russian currency, which gives them an advantage in the export market versus the United States.
You mentioned the trade war. Is that now starting to fade into the background in regard to news?
Well, I guess it's depending on who you talk to. If you read the newspapers, you think that the President of China's speech softened some of the rhetoric. But the concern is amongst people behind the scenes is that they will not do anything about Section 301, which is the information that we have in intellectual proprietary information. Without that negotiation change, tariffs will be imposed.
Finally, Steve, when's the next USD report, and what will be the most important thing to look at in that report?
The May 10th report is the first time that they'll look at a new S&D for next year, 18 and 19, for all three corn, beans, and wheat. So for corn, they actually could show a little bit lower carryout because of lower acres and a trend yield, which might be a little supportive, keeping us in a trading range. Beans, they might show a carryout bigger because they'll look down and say, okay, next year Argentina will have a normal crop, and so stocks will go up and things will get kind of back to normal from too much supply in the world. We'll also have to watch and see if there are trade issues between China and U.S. Will China actually lower their import numbers, and will they actually sell the reserves they have to offset lower imports? And for wheat, there's just too much wheat. It looks like the Russians will grow another record crop, and they'll be exporting wheat and taking it into consideration. Less trade from us.
We'll see what that report says. I want to throw one more question out to both of you regarding the energies markets, particularly crude oil. The market has been trending higher since the middle of December. In fact, current prices are the highest we've seen since December of 2014. Can either of you comment on the crude market and lend us your thoughts on where we might go from here?
I think that, to me, there's two things. Number one is that OPEC and all those countries are trying to hold together their coalition to reduce global stocks. But on the other hand, here fracking in the United States continues to increase our stocks and our supplies. And as we get more electric cars, we'll have less demand. So I think that right now the trend is probably a little bit higher as the coalition controls the production of global crude oil, but we won't get out of control because of our fracking.
Okay, my feeling is that Steve is absolutely right, that the price of crude oil will continue to advance as the global economy continues to improve. And the Saudis are, as Steve mentioned, are trying to control production. So my outlook is for higher prices for crude oil.
All right, remember the views and opinions expressed today on this video are solely those of our guests and should not be construed as the views or opinions of ADM Investor Services or Archer Daniels Midland Company. If you'd like more information about our brokerage services, would like to speak to one of our experts about managing your risks, or would like to open a trading account, please visit www.admis.com.